Welcome to the STR Data Lab.
Hello, and welcome to the latest edition of the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and I'm joined again by my trusty co-host, Scott Sage. Scott, welcome out to the show.
Jamie, pleasure to be back.
How's your summer been? I feel like we've kicked it off, at least in the Southeast. I know in Denver, it's been a warm one. We got back from Skift. We were both up in New York at that, what I thought was an amazing conference. So how have you been doing?
Excellent conference at Skift. You're right. My summer's been delightful. San Francisco, the weather doesn't change much. So in San Francisco, it's actually quite chilly. So quite the opposite of what you're experiencing in the Southeast.
Yeah, and I was out in San Francisco with you for a conference, and you took me on my first Waymo ride. That was so cool. If those of you who haven't seen it, like these are full self-driving taxis. There's no person in it. You get in, it takes you to your destination. I still feel like it was magic, and I've showed so many people that video. My kids were just blown away that I was sitting in a car with no one driving in it and that it was taking me around the city.
I think that's your next vacation. Just take the family and go for a long ride on a Waymo.
Though I did see one driving around in Atlanta yesterday. It had someone in the seat, but
Training.
they're training. Yeah.
All right. Well, Jamie, we're here to talk about May's market performance. And the expectation here was we've had some non-normal months to start the year, as we've talked about thus far. In January and February with the winter and the weather. March, we had the Easter shift forward. April was down because of that Easter shift. May was supposed to be the first normal month, right?
Yeah. And if May is an indication of things to come, like bring on May. Like, I mean, it was finally what looks like things sort of shaping out to and a healthy market. So are you okay if I just run down some of the top line numbers?
Let it rip.
So, and overall, what we saw in May was supply, available listings up 7%. For those of you that have been following along, note that 7% is the lowest growth that we've seen in like 3 years. So super excited to see that 7% number. Demand nights, and how many people are staying in short-term rentals? How does that compare to last year? And the key, I think, health figure of just like, are there more people, more renters, more people coming in, up 11%. That was a very healthy number. Demand growing faster than supply. I haven't said that in a long time. Meant that we actually saw occupancy growth of 3%. So it's a very healthy number. I'll note though, that 3% growth is up off of last year, but still below 2019 levels. And that's, I think we're sort of in this sweet spot of growth, but still down relative to 2019. Like, and I wouldn't say things are like sunshine and rainbows, but we're trending in the right direction. ADR growth up 1.5%. There is significant mix shift in this data. So that's something to take home of when we're looking at same store, same unit basis. Growth is significantly lower, flat, slightly down. So the fact that we have more people renting larger homes today than we had last year means that the average rate being paid by a guest is slightly larger just because the mix is different. And then you sort of add the occupancy and ADR. We did see a RevPAR increase of 4.5%. For those traveling or following along at home, we had seen 2 years consecutive declines in RevPAR. We've now seen 2 months of increase, and one because of an Easter shift. And now May, this could be an indication of the trend going forward of turning those negatives into positives.
Yeah. And what's that, Jamie? Do I hear the cheers from all existing operators about this available listings number? And maybe it's not cheers, but at least an exhale, because as you said, it's been the consistent theme that the supply growth continues to grow. And here, despite its growing, it's the lowest we've seen in the past 2 years.
Yeah. I'll note that these are cheers from existing operators, not from investors.
That's right. existing operators. And so where you mentioned the different geos. So on this listings number, what did we see across the different market types in terms of supply growth or supply stagnation?
Yeah. So interesting thing to call out. One is urban location type. We saw a 2% decline. So there are 2% fewer listings in urban areas today than there were at the same time last year. When we call out some of the markets that's causing that, and the big one is New York, supply down 35%. Supply for short-term rental listings, i.e. listings that can accommodate guests less than 30 days, is down 83%. So New York obviously impacting the data, but it's not just New York. We've got San Jose, Palo Alto, supply down 7.5%. That's your neck of the woods. Maui, supply still down, impacted by the fires, down 5%. Atlanta, supply is down 3%. Sacramento down 3%, Philadelphia down 2%, Phoenix down 2.5%, Santa Barbara down 2.5%. So there are really some major metro areas that are seeing declines in listings. And I think a positive for those operators in there, but I don't think we can move past the reason why a lot of these markets are seeing declines, whether it's regulation, natural disasters, or in the case of market like Atlanta, like it's just really weak operating performance right now. Like some of the demand drivers around movies, films had been really weak with the recent writer strikes and just really waiting for that demand to really ramp back up.
And effectively, Jamie, like as we look historically over the past 24 months, we've seen this supply growth outpace demand growth in general. And now, is it fair to say that that trend has been driving these occupancy rates lower, ADRs lower, revenue lower than what operators would feel comfortable with? And now we're starting to see some listings come offline, or maybe people stop investing and have a bit more caution before entering the market? Or what do you think the key driver here is to this change in supply growth?
Yeah. And one is lack of new investment. And it's not that no one's investing, it's that we're seeing a slowdown. And so I had called out a few markets that with declines in listings. Those are about the only ones. Like we're only seeing about 20 markets out of our 375 with actual declines. So it's not like people are leaving en masse. What's generally happening is the rate of investment is slowing. And that's where, and we go down to the other side of the list of markets that are actually seeing, and there's another 30 that are seeing greater than 20% supply growth. So it's not that everywhere is seeing this slowdown, though most are. And when we look across the location types, so we talked about urban seeing a decrease. Suburban areas of those same cities are actually seeing a 5% increase. Mountain and coastal markets, so the traditional vacation rental markets, both seeing growth of around 7%, and both seeing a deceleration from around about 10%. So that growth rate and decelerating from 10 to 7, while it may seem like not a big change, like that is significant in a time when an overall demand for short-term rentals is growing at about 7%. And then where we still see outsized growth is in the small and mid-sized cities. So areas outside of major metros and outside of the traditional vacation rental markets, growing anywhere from 10 to 15%. And that's where we see that outsized sort of growth. So some of the top growth markets, we've got Bloomington, Indiana. We've got Buffalo, Niagara Falls. We've got Albany, New York, Tuscaloosa, Alabama, Indianapolis, Cleveland, Broken Bow, still seeing pretty significant growth of a 25%. So not maybe your top investment markets as you would think of them, but I'm seeing a lot of markets that were called out in our best places to invest, of areas where it still actually makes sense to invest in, given the sort of home value revenue opportunities. So when I look across like where the areas that are still seeing supply growth, these are the type of areas that if I was investing right now, I'd be looking to deploy into and and broadly, like I'm pretty happy when I see supply decelerating and the areas that there's still healthy growth are areas that it probably makes sense and that there's healthy investment opportunity in.
Is this an anomaly or the start of a trend here, Jamie, around demand outpacing supply?
So our forecast and where I think sort of organic demand growth is right now is about 6-7%. And that's where we see two components. Like one is just increase in overall travel spend. And long run average for that is about 2%. Like, and overall, just people, population growth, amount of money that people want to spend on travel continues to grow. That's sort of organic. And then you've just got short term rental adoption, which our industry is still in this adoption phase where we're stealing share from the hotel industry, which adds another 3 to 4%. So that's how I sort of get to that 7%. And that I expect to stay for probably the next 1 to 2 years. And that's what our forecast calls for. Then the sort of wild card, and the wild card over the past 2 years has been supply growth. And yes, in some markets, supply can create demand. And for a lot of people, that notion of like, wait, if I build it, they will come. Like, yeah, like a lot of markets, there is just so much unsatisfied demand. Demand during peak season that just has nowhere to go. And unless supply comes in to accommodate it, like people aren't going to travel that destination or they're not going to take a trip or prices end up being too high for people to travel to that location. So supply can help induce demand growth. We do see that in some markets. But right now we're at that point where if all of a sudden supply accelerated back up to 10-15%, I suspect demand's probably going to be still like 7-8%, which means further occupancy declines. So where we've sort of reached equilibrium now, and remember that was our theme for the year, of that we thought we were going to reach equilibrium. I think we're there. 7% supply growth, 7% demand growth on average that we've seen. Our demand growth is sort of averaged in the first half of the year, 7%. Supply growth is just meeting that. And I think that's the trend for the back half of the year, which should equate to flat to slightly increasing occupancies, which we haven't seen in some time.
What are some demand drivers we should be paying attention to as operators in this space?
One that I am keenly focused on right now is the return of international travel to the U.S. this summer. We have been painfully behind the international travel scene of being able to attract guests back to our country, back to the States. A piece of that has been the strength of the dollar, which we have no way to control. But the other piece is just marketing the country, being open, making visas available, bringing Asian travelers back to the country. China was the number 2 inbound country for travel to the US prior to the pandemic. It is not nearly back there. So what can we do to sort of hang our shingle back out there saying the US is open? We want travelers coming in and visiting the country and the associated revenue with that.
Got it. Revenue, though, in May, Jamie, up 13% year over year. What drove this growth?
Yeah, we talked about the increase in demand, and that's the major driver of just there's more people staying, and then the subsequent sort of increase in rate. And rate is a tricky thing right now because on one side, as we talked about, we've got more people staying in larger units, which can sort of increase the sort of reported rate that we show out. The other piece is that over half the markets in the US right now are seeing declining ADRs. And that means same unit, you're renting out now and you're having to cut your rate from the year prior. And this went in a time when costs are going up and all the things associated with running your unit is getting more expensive. This can really eat into the profitability of your listing and operating it. So some markets that we're seeing some pretty steep overall ADR increases, and these are like some pretty like important vacation rental markets. You got areas like Vail, Frisco, so the Colorado mountains. I seem to remember this time last year, we got like an extended ski season. And this year we're not getting it, which sort of equates to I can't charge ski season rates in a time where we don't have snow anymore. Another one, Napa Valley, seeing rate declines of about 15% year over year. Scott, you're not making those trips out from San Francisco. What's going on?
You got to start doing your part.
Yeah. I wouldn't say we've got back into the reinvest period of and San Francisco tech, like, and spending willy-nilly, though I am kind of wishing that we were all part of NVIDIA. I saw a alert that they were now the most valuable company. So maybe we need to start marketing to those employees out in the Bay Area. And then, and we've got to sort of talk about some of the positive ones too, because there are some markets still seeing significant ADR growth. A lot of them, though, are in areas that sort of go on the opposite end of the spectrum. We have area like New York seeing some pretty significant ADR growth. Des Moines, Moab, Fredericksburg, Texas. Fredericksburg had been a market that was hurting pretty hard, seeing some growth again. Coachella Valley, not as strong during the Coachella Festival in April, but we've seen to have had a rebound in May. So, like in general, all this is local. And every market and the trend is different in terms of what we're seeing in terms of overall supply growth. Is it slowing? Is it not? Is it accelerating? And how are the pricing trends? What's going on with lead times? Broadly across the US, we've seen lead times continue to decelerate, which means people are waiting longer to book. And when that happens, we see the revenue management programs like our smart rates. Like, if we don't see the demand that we're used to seeing, and we don't think that you're going to get booked, like, our algorithms are going to say, like, hey, you should start lowering rates because we're not seeing the demand that we typically see. And if you want to get your property booked, like, you're going to have to cut to make sure that you get it. So, and that's pretty much how all of them work. So the fact that lead times continue to slow, even though we end up getting the demand, and a piece of getting that demand might be like, and a part of that 11% demand growth is that hosts now are willing to cut rates to help people sort of make that last minute decision of like, I wasn't going to go to Steamboat for the weekend at $200 a night, but $180 a night, like, or $150 a night, like, let's do it.
All right. So that's looking backwards at May and talking about what we've seen for the past 5 months to start this year. Give us a snapshot forecast for the rest of 24, Jamie.
Yeah. So, and you know this, and our listeners might not, but there's two ways we go about doing our forecasts. One is looking at current pacing. So what's on the books today, and how does that compare to years prior? So when we look at on the books demand for the rest of the summer, we're seeing demand up about 10% compared to last year. So we just talked about sort of May up 11%. The fact that I'm seeing and demand in June up 9% and July up 11%, that makes me feel pretty confident for the rest of the summer that the demand's going to be there. People have been booking far in advance for those peak summer travel periods. Like, most of the revenue our industry earns is in June and July. And so that's looking pretty solid. When we look at overall rates, and we are continue to see growth. So that makes me feel pretty good. Now, heading into the back half of the year, and so past summer, that's where things start to get a little bit more uncertain, because we don't have sort of, and yes, there's pacing, but it's significantly fewer nights, and like, people just aren't booking trips now for October, November, December. So that's where we start to incorporate more forecasts around what's going on in the overall economy. And that's where the outlook has gotten a lot rosier than, let's say, this time last year. So right now, Oxford group we use to get our economic forecast is forecasting full year employment growth for 2024 up over 1.5%, real personal income up over 2%. And I'll note that that sort of metric, real personal income, so that's nominal, like what are you pulling in terms of all forms of income, subtract out inflation, and then what's left. And so even after the increases in inflation, we're still seeing positive increases in income. And that's going to relate to real consumer spending of up over 2%. So the question then is are people going to prioritize travel on their spend? And that's broadly what we see happening, continuing, especially on the upper end. A lot of these gains in real income are happening on the upper end of the consumer. And so when we sort of bifurcate our data on like higher end listings versus lower end listings, we are seeing much better performance both on the ADR and occupancy side from the upscale luxury properties as opposed to the budget and economy ones. And that's something to continue to watch. If we do see continued pressure on consumers, especially on the lower end, those properties, those hosts that are going after those lower end consumers, and there's a lot of them. Like, and you just look at Vicasa's portfolio, like most of it is budget and economy listings. It's not the upper end. So you really have to think about what type of consumer am I trying to go after? Because you look at these economic data points of like, oh, everything's fine and rosy. It's not fine and rosy for everyone in the economy right now.
Yeah, I think you call out an interesting trend, which is this luxury and upscale inventory type. The other one we're seeing is year-over-year demand growth for effectively what you could call group travel. So 2-3 bedrooms. We saw 5+ bedrooms up, significantly year-over-year as well. And so we talked about this on a prior episode of Airbnb starting to prioritize the group travel as well. If you're a property manager, the ones who have been in this luxury upscale space have been performing best over the past few years. And that trend, what I'm hearing you say is based on these economic factors that we're seeing, should continue to hold true moving forward.
Yeah. And I'll note when we calculate our price tiers, so which properties are showing up in upscale and luxury, it's not just the larger units. Like we're controlling for the number of bedrooms in the property. So it's like the top 20% of ADRs, 4 or 5 bedroom listings in a market. And even in that, like, and we're seeing just so much more demand growth happening in these larger listings as opposed to the smaller ones. So it really gives me confidence in short-term rentals that are able to differentiate themselves from hotels and really going after the niche where short-term rentals win. Because hotels, I would hate to be competing with them in the markets that I operate because they've got full-time revenue managers. They've got full-time sales staff. Like they've got so much manpower that they can put behind selling the rooms. Like if I just have a better product of like, I've got a 5-bedroom house on the water where someone can take a vacation with their family and extended family. And that experience just beats a hotel 9 times out of 10. Like I feel confident in the ability to continue to grow that demand and continue to differentiate the product. And those are the areas where I see and short-term rentals win. When it's in urban areas and where you're competing directly with a hotel, primarily the only way you're going to win is on price. And that's a really tough situation to be in if you're operating, that you've got to come in with potentially the better product, but where you're going to have to compete and have a better price and to win that guest.
It's a microcosm of what we've been talking about of, these luxury upscale and these larger properties. There's limited supply there despite the growing demand for that same inventory, and therefore they're outperforming. So Jamie, we've covered a lot. Let's maybe summarize this and package it up with your 2024 forecast for RevPAR. I think there's some interesting news here. You shared it recently at Skift when you look at it relative to the prior 2 years.
Yeah. So, and for those of you again, following along, like we saw declines in RevPAR in 2022, down 1.5%. We saw a decline in RevPAR in 2023, down roughly 8.5%. We are calling for RevPAR to increase slightly, 0.5% in 2024.
A positive number is a positive number.
Yeah. And that is entirely predicated on the back half of the year being positive, because the first half of the year, while I'm volatile, some up, some down, it was clearly a negative print for the first half of the year. So our expectation is that the back half of the year is better, and better enough to pull the full year up positive. We do expect 2025, though, to be positive. Our expectation right now is 2.9%, almost 3% RevPAR growth. That is a nominal number. So if overall expenses in your property are growing by 3%, that means we might be able to stay sort of neutral in terms of profitability. I would say like my biggest risk there, and I sort of hinted at it earlier, is that supply growth stops decelerating and starts either pause or begins to accelerate again. And that's where I'm watching the interest rate numbers. So 30-year fixed as of recording today, like is at 7%. 2 months ago, that was at 7.5%. So if we continue the downward trend in interest rates, that could start to induce more investors to start to come in. And I know I talked to a lot of investors that say they're waiting for a 5 handle. They're waiting for interest rates and for that 7% to tick down to a 5%, and then they're buyers again. But what is that sort of tipping point? Is it 6%? Is it 6.5%? Is it 5.5%? And we don't really know. My intuition is that it's got to drop below 6% to really start to turn the deceleration into an acceleration again. But that is a wild card out there of what's going to happen in the overall housing market, what's going to happen to interest rates, and how that sort of plays into the mind of investors around the country.
And that would be a slow burn. That's not something that's going to happen abruptly. So we should have some signal of when that's happening and forecast when we can expect that. To your point, we don't know what that tipping point is, but we can start to see the trends as it changes.
And the Fed sort of has come back. Like at the beginning of the year, they had indicated 3 interest rate cuts. Dot plot now says 1. And my expectation is still might be 2, like a September and December cut. If I had to bet on something, inflation came in at flat last month. It's only 3.5% or 3.3% on a year-over-year basis. We are seeing positive signals that the Fed might be able to start cutting rates soon. So good on one end, bad on the other. And I guess yet to be seen on what it's going to mean for our clients and people in the sector.
Well, we started with some good news on the supply number for existing operators. Let's end on some good news with what you just shared around positive expected RevPAR growth for 2024 and into 2025.
Yeah. I hope it comes true. That's our outlook. I'm sticking to it until we update again next month, and we'll see what it changes to. But
there's your good hook. Come back next month to see how this
Yeah, and also I'll just mention I'm going to be out in Denver next week, so this should come out on Thursday the 20th. Be out for the Real Estate Robinson's STR Summit Conference. If you're there, if you're a listener, please find me, reach out. Would love to chat.
Excellent. Great stuff, Jamie.
Thanks, Scott.